Today, FTX reportedly abandons plans to restart after bankruptcy. XRP prices swing as a co-founder's crypto wallets are hacked. And Chuck Mounts, chief DeFi officer at S&P Global Ratings, discusses the agency's recent stablecoin stability assessment. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Major cryptocurrencies are in the red this morning. Bitcoin hovered right around $43,500, while Ether fell about 1% as of noon Eastern. XRP, meanwhile, taking a hit this morning after a hacking incident temporarily drove the price as low as 49 cents. By noon, it had recovered to 51 cents. Okay, let's talk more about that hack hitting XRP's price. Blockchain sleuth Zach XBT pointed out in a post on X that around $112 million in XRP had seemingly been stolen on Tuesday. Speculation that the Ripple platform had been hacked sent the price of XRP tumbling. But in a post on X this morning, Ripple co-founder Chris Larsen clarified that it was his own personal accounts that had been accessed, not a hack of Ripple itself. Larsen said the problem was quickly caught and exchanges were told to freeze the affected addresses. He also said law enforcement was involved. All right, some other stories you should know about. FTX is reportedly abandoning its efforts to restart after exiting bankruptcy. Reuters cited a company attorney as saying that FTX had been negotiating with bidders and potential investors for months, but none were willing to put up enough money to rebuild the exchange. Now, in that same court hearing, FTX also reportedly said it expects to repay customers in full, more than a year after the commingling of funds by Sam Bankman-Fried and other executives forced the collapse of the once popular exchange. And finally, former British Finance Minister George Osborne is joining Coinbase as a global advisor. The exchange's chief policy officer posted the announcement on X, saying George is one of the most experienced and thoughtful leaders in government and business, and that Coinbase is grateful to have his advice and counsel as the company expands globally. Here in the U.S., the exchange faces an ongoing legal dispute with the SEC, and CEO Brian Armstrong hinted at relocating the company to the UK if regulatory uncertainty persists. Coinbase has also told CNBC that the company chose Ireland as its hub in the EU, where MiCA regulations come into effect at the end of the year. All right, you might think of the S&P as being tied to traditional finance, but they're making a big push into the decentralized finance space as well. Crypto World's Talia Kaplan spoke with Chuck Mounts, chief DeFi officer at S&P Global Ratings, about the agency's recent ranking of stablecoin stability and what else it's doing to leverage its analytical and risk assessment capabilities to support both TradFi and its growing DeFi client base.
I want to start off by asking you why stablecoins are considered a critical component in the crypto ecosystem. How is S&P Global thinking about the stablecoin market in 2024?
Right. So when we were ideating what is the right product that we should strive to bring to market to leverage our historical expertise and credit risk analysis into the crypto finance ecosystem, we did an extensive market sounding with across a wide range of stakeholders. So TradFi, crypto native, buy side, sell side, regulators, policymakers, academics. And when you speak in markets, there's rarely a unanimous view towards anything. But there was actually a unanimous view that the marketplace needed a better insight into the risks that exist, both idiosyncratic risks and macro risks that exist between different stablecoins. And so that really spawned our interest in the topic and thinking about how can we create a product that will help market stakeholders understand those risks between different stablecoins and the risk of them depegging against their targeted one-to-one against a fiat currency. And I think that the reason stablecoins have gained so much attention from that wide range of stakeholders, when we started this conversation, UST hadn't even happened yet. And those were the comments we received. And then after UST, those comments just accelerated from there. And I think one of the key reasons that exists is because the stablecoins play an integral part of the crypto finance ecosystem. And you can see that in the market cap and growth of the stablecoin ecosystem, but also because they serve as a bridge between traditional finance and crypto finance. So from both those perspectives, we thought this was a very logical place for us to leverage our historical expertise of credit risk analysis and go into what we would consider an adjacency to that core competence for us.
Expanding on that, in December, S&P Global Ratings launched what's called a stablecoin stability assessment. It ranks the stability of several stablecoins. So Why did S&P Global think an assessment like this was important, and what were some of the factors considered? I can imagine regulation is one of them.
Absolutely. So we had to create first of all, a new set of criteria to evaluate and a method, and then wrap those into a methodology to capture a systematic approach to the risks inherent in stablecoins. And unlike a credit rating, the stablecoin stability assessment is really targeting a specific thing, which is the risk of a stablecoin depegging from its targeted one-to-one relationship with the fiat currency. So in order to do that, we took all that input we had from having market discussions, and then we undertook a very specific and targeted market sounding with a range of stakeholders to get their input on what are the factors that they think are most relevant and critical to the risks of stablecoins depegging. So in our methodology and our framework, it all starts with an evaluation of the asset quality that underpins the relationship to fiat currency. And then there are 5 additional factors that get kind of included in that evaluation. So you start with the asset quality score, then you add in the additional factors. The additional factors, at the best case, will leave the asset quality score where it is, or they can bring the score down. So there's no way to raise the score from the additional factors, but only to lower it. And those additional factors include things like you mentioned, for instance, like governance, legal and regulatory frameworks, redeemability and liquidity as an example, as well as third-party dependencies and technology and track record. So there's a very robust framework that combines all the idiosyncratic risks, what we believe to be the most important idiosyncratic risks of a stablecoin, as well as some of the macro factors that go into a stablecoin being able to maintain its one-to-one peg.
So out of the 8 stablecoins analyzed, USDC, a stablecoin pegged to the US dollar, got a strong rating, for example, while others, including Tether, didn't fare so well. How did S&P Global reach these conclusions, and what are some of the findings of that assessment that jumped out at you?
Yeah, so as I said, they really start with the asset quality score. And you can see that when you go through the scoring methodologies, we rank the stablecoins 1 to 5, 1 being the strongest and 5 being the weakest. And you can see that there were several, or 2 coins in particular, that had an asset quality score of 1, but then had the additional factors brought the score down by 1. The other stable coins that we provided a score on ranked anywhere from a 2 to a 5. And that is really looking at the features that go into the asset reserve, the accessibility, the attestation, things of that nature. So, depending on how the analytic team views the strength of the asset quality, that's where the rating would start.
Now, you noted that the development of smart contracts increased substantially during the recent crypto downturn, which you said was precipitated by the Terra Luna stablecoin collapse. That collapse set off other implosions, of course, and led to a lack of trust in the industry. In turn, we saw asset values plunge. But now we're seeing prices move higher, with Bitcoin hitting the $43,000 mark this morning. And we're seeing optimism in the space with developments like spot Bitcoin ETFs trading here in the US. So what has shifted in this current backdrop, and what's your outlook for the DeFi space in this environment?
Yeah, so it's been a crazy year. I guess if you've been in crypto finance from the beginning, or crypto from the beginning, you could probably say that almost any year. But I'm very excited about the progress that the ecosystem is making and that players in the marketplace are making. And what I see from the seat we sit in is that the technology advancements continue to run full steam ahead. And even though crypto valuations from the beginning of the bear market through the end of last year were probably down maybe 70, 75%, what you saw was that smart contract development was up hundreds of percent. So despite the decline in valuations in the marketplace, the technology advancements, the innovation in the space just kept galloping ahead. And I think that portends very favorably for the ecosystem and for the evolution of this new set of rails that will complement and disrupt the traditional financial rails. And one of the things that I think is most exciting also is that you see many of our traditional clients launching digital asset teams, building tokenization platforms, participating in regulatory sandboxes around the world, all of which are helping build capabilities and bringing a robustness and more institutional framework to the crypto financial markets that I think will unlock the potential to transform how financial markets function. So I think we're still, when it comes to DeFi or the harnessing of blockchain and crypto financial rails into the financial ecosystem, we're still in the early stages, and I would say things are still kind of in an experimental stage, but we're on a clear pathway towards mass adoption, and that mass adoption will be fostered by market participants elevating their capabilities, by policy frameworks becoming kind of established and more integrated, and by the advancements in technology, all of which will lead to what we ultimately believe will be the mass adoption of these financial intermediation capabilities.
Okay, that's all for Crypto World today. We'll be back again tomorrow. We'll see you then.